Welcome back as we move on to multi-stage free cash flow models. Like for single-stage models, we have to emphasize that multi-stage free cash flow models are very similar in concept to multi-stage dividend discount models. As such, we will not repeat the explanations here. Do master multi-stage DDM before attempting this lesson. Let's get started. Regardless of the number of stages in the multi-stage model, the overarching principles remain the same. The final stage should be the constant growth stage, where the final free cash flow estimated from the previous stage is used to calculate the terminal value based on the long-term growth rate of cash flow and a discount rate R. For the earlier stages, you may need to forecast the cash flows based on short-term growth rates and the current cash flow. Discount all the cash flows and terminal value and sum them up, using WACC for FCF models and required return on equity for FCFE models. The result is the firm value for FCFF models and equity value for FCFE models. And that's it. All this is stuff you should already be familiar with, so it's a matter of piecing it together. There are several other differences from dividend discount models that you need to take note of, but they are best explained in the practice questions. Without further ado, let's start with a simple two-stage FCFF model. Selected financial data of Yippee Corp is given below. An analyst estimates that the company's FCFF will grow at 8% for the next 3 years, followed by a perpetual growth rate of 4%. Furthermore, she expects the WACC to be 12% for the 3 years, dropping to a perpetual 9% after that. Determine whether the company's shares are overvalued or undervalued based on two-stage FCFF model using the analyst's assumptions. Let's first calculate the current FCFF for the company. Since net income is given, we use the net income approach. You should be able to recall this equation by now. Plug in all the figures, assuming that depreciation is the only non-cash expense, we get an FCFF of $50 million. We're told to use a two-stage FCFF model with a constant growth rate of 8% for the first 3 years, and a constant growth stage of 4% growth rate. Now, there is one interesting detail given, that the discount rate is different between the two stages. Thus far, we've always been assuming the same discount rate for all stages. However, this should not stump you. For this case, simply use 9% as the WACC for calculating the terminal value, and 12% as the WACC to discount all the cash flows to find their present value. Let's first estimate the FCFF for the short-term growth stage. Compounding the current FCFF of $50 million at 8%, we get the following FCFF for the next 3 years. To calculate the terminal value, we use the last FCFF from the previous stage. Do make sure you use the long-term growth rate of 4% here, and using the WACC of 9%, we get a terminal value of $1,310.1 million. Now that we have all the cash flows and terminal value, let's calculate the firm value. To speed up the process, we shall just use the cash flow feature on the calculator. Punch these figures in, take special note that the WACC is 12% for these 3 years, so the discount rate is 12, you should get $1,072.04 million as the firm value. Once again, don't forget that as this is the FCFF model, you need to deduct the market value of debt if you wish to get the equity value. And based on 10 million outstanding shares, the value per share is $77.20. Since the current stock price is $89.40, which is higher than the intrinsic value of the stock, we conclude that the company's shares are overvalued. Next, let us look at an example of a two-stage FCFE model. eQuick is a maturing company which had total sales of $50 million and $16 million in net income. The FCFE for the year was $14.25 million. An analyst estimates that sales growth will slow and net profit margin will decrease over the next 3 years, as shown. The analyst also made the following assumptions. The required return on equity is 8%. Incremental CapEx, which is fixed capital investment net of depreciation, is projected to be 40% of the sales increase in each year. Working capital investments is projected to be 10% of the sales increase in each year, and that debt will finance 30% of the net investments in fixed capital and working capital. Based on all these assumptions, calculate the FCFE for the next 3 years and estimate the firm's equity value. You may assume the firm's long-term FCFE growth rate to be the same as the third year's FCFE growth rate. Unlike the last example, this example requires us to make component forecasts. Let's go through them one by one. Based on the assumptions, these are the sales forecasts for the next 3 years, and based on the forecast margins, these are the net income figures. Incremental CapEx is 40% of the increase in sales. For example, the forecast increase in sales in year 1 is $4 million, so 40% of that is $1.6 million. Likewise, working capital investment is 10% of the increase in sales, So for year 1, it is $0.4 million. Net borrowing is assumed to be 30% of the net investments in fixed capital and working capital. For example, the total net investments in the first year is expected to be $2 million, so the expected net borrowing is $0.6 million. And FCFE is net income minus incremental capex minus working capital investments plus net borrowing. These are the forecasted FCFE for the next 3 years. Based on these forecasts, the growth in FCFE for the 3 years are as follows. Of particular interest is the growth in the third year, as this is our assumed long-term growth rate for FCFE. With that, let's proceed to calculate the terminal value, and here is where it gets a little tricky. Given the third-year forecast, this is actually the forward forecast of the constant growth stage, so the terminal value is at the end of the second year, not the third. In other words, the constant growth stage starts at year 2, not year 3. The terminal value is calculated as the next period's cash flow divided by the required return minus the constant growth rate. That gives us a terminal value of $309.6 million. And with that, let's discount all the cash flows and terminal value using the given required return of 8% and sum them up. This third-year forecast is only for the calculation of the terminal value, and it's already accounted for in the terminal value, so we should not include it. Punch these figures into your calculator, and you should get the equity value, which is $294.4 million. Let's now move on to 3-stage models. Max Growth Corp's latest FCFF is $30 million. An analyst expects FCFF growth to be 20% for the next 3 years, followed by a deceleration in growth. From the 6th year onwards, FCFF growth is expected at a constant 6%. The firm's WACC is 11% and is expected to remain constant throughout the stages. Market value of debt is $400 million. What is the value of the company's equity using the 3-stage FCFF valuation model? Let's first define the stages. Based on the analyst's assumptions, the first stage is a high growth stage of 3 years where growth is 20% each year. This is followed by a 2-year decelerating growth stage and a constant perpetual growth of 6% from the 6th year onwards. Based on the assumed growth rates for each year, we can calculate the FCFF. Now let's determine the terminal value. Always remember that the terminal value is at the very beginning of the stage, which also coincides with the last cash flow in the previous stage. So here, since we already have the forecasted cash flow for the next year, we can use it directly. The terminal value is $1,365.6 million. Since there are so many cash flows to discount, we shall use the cash flow function in the calculator to speed things up. Punch these figures into the calculator and make sure the discount rate is the WACC of 11%. Solve for MPV, and we get a firm value of $992.98 million. And to solve for equity value, we deduct the market value of debt, which is given at $400 million. The value of the firm's equity is therefore $592.98 million. And for our last example, let's look at 3-stage FCFE valuation. Steady Growth's latest FCFE is $10 per share. An analyst expects the company's FCFE growth rate and required return on equity as follows. What is the value of the company's shares using the 3-stage FCFE valuation model? This time round, you should have some confidence to attempt the problem before we go through the solution together. You may want to pause the video now and work out your answer. Do take special note that the required return on equity is not the same for all of the stages, so you may have to discount the cash flows using different discount rates. And we're back. Let's first define the 3 stages. We have high growth stage for the first 2 years, a mid-growth stage the following 2 years, and constant growth stage from the 5th year onwards. Apply all these growth rates and you should get the following FCFE figures. You should be able to identify where the terminal value is, which is at the end of the 4th year, and calculating the terminal value should be second nature to you by now. Plug in the appropriate figures, you get $260.83. Make sure that the correct required return is applied here, which is 11% for this stage. And here comes the hard part, which is to discount all the cash flows using the appropriate discount rate. If you had done this, sorry to say, this is wrong. This is because if you discount this cash flow this way, you're discounting by 14% for all 3 years, which is wrong. Rightfully, you should be discounting this term by 16% for first 2 years and 14% for 1 year. Likewise, this term is also wrong as it is discounting by 14% for 4 years. Rather, it should be 16% for the first 2 years and 14% for the next 2. Punch this long list of numbers into your calculator, and you should get a stock value of $185.56 for the company. In this lesson, we went through 4 permutations of free cash flow models. After going through these examples, you would have noticed that multi-stage free cash flow models can have several possible permutations. They are: the model can be 2-stage, 3-stage, or even more stages if appropriate. The cash flow can be FCFF or FCFE. The discount rate, that is the WACC or required return on equity, can be uniform or different across the stages. And forecasting of growth in total free cash flow, or forecasting the growth rates in the components of free cash flow. As you can see, the number of permutations that can appear in the exam is quite a lot, and we can't go through every single permutation. Nevertheless, what matters is that you're able to piece together the different concepts and techniques that you've learned to solve the problem. In essence, remember this: that regardless of the number of stages, find the terminal value and the short-term cash flows and discount them using the appropriate discount rates. With that, we've concluded this topic on free cash flow valuation. Take a break and we'll see you at the next topic.